You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is distressed note expert Chris Sevigny. Now, Chris is the president of Sevigny Investments, a distressed note investment firm operating out of the Virginia, D.C. area. Now, Chris has been a real estate professional for more than 20 years, and outside of his note business has developed more than $750 million in real estate. And to add some additional context here, Chris actually operates his note investment fund while working a full-time job as a director of construction for a Washington, D.C.-based development firm. Now, Chris has built systems and processes that allow him to operate a multi-million-dollar note investment firm, all while maintaining a full-time occupation that he loves in the development sector. And so, guys, in this interview, Chris and I are going to cover a litany of topics, including how Chris has been able to build a successful note investment business, all while working a full-time schedule and raising a family. You're also going to learn how to quickly conduct a back-the-napkin valuation on a batch of notes. You'll learn the difference between a non-performing note and performing note, and which Chris prefers and why. You'll learn about what percentage of non-performing notes end up in foreclosure after an unsuccessful restructuring with the borrower. You'll learn about the various pitfalls that exist within the note space and what you need to be looking out for. You're also going to learn about what the exit strategy is once a distressed note is stabilized and performing. You're also going to learn about the regions and or markets that Chris loves and which ones he steers clear of and why, and much, much more. And so with that, guys, I'm excited to get onto it with Chris. But before we do, just have a few quick housekeeping items. Now, I just want to remind you about the book that my team and I just wrapped up. We're offering it for free, and it's about the merits of investing in parking lots and parking garages. Now, guys, this is one of the most misunderstood and undervalued asset classes that exist today in the commercial real estate world. And those are just a few of the reasons why we are so excited about this niche. Anyway, the book is called Parking Lot Profits, and you can download your free copy by going to parkinglotprofits.com or by texting the word parking lot to 31996. Again, text the word parking lot to 31996. Moving on here, guys, we just launched our brand new partnership program called Bring Kevin a Deal, and this is where I'll pay you as much as $200,000 for any one deal that is referred to me that I end up purchasing. Now, to learn more about this opportunity of working together and to also download my deal acquisition criteria guide, you can go to bringkevinadeal.com. Again, that's bringkevinadeal.com. And guys, if you love what we're doing here at the Real Estate Investment for Cash Flow podcast, please take a moment to subscribe to the show if you haven't done so already. That will ensure that you don't miss any new episodes that come out. In addition to that, if you haven't done it, please take a moment to leave a rating and review. It helps us attract awesome guests like Chris to the show. And lastly here, before we get on to it, just want to remind you of the free 30-minute phone call that I offer each and every Friday. This is where I open up 3 different 30-minute time slots with me. Been doing it for years now. I've talked to hundreds of folks over this time, and I would love to chat with you. And this is a way that you and I can connect and talk about everything and anything regarding real estate investing. Whether you're brand new to the business or a seasoned pro, you can simply go to my website to get signed up, kevinbupp.com. Just please, all I ask of you is that you include some detailed notes when you're making that appointment so that I know what you'd like to chat about during our time together. Again, kevinbupp.com to schedule that appointment with me. And now, guys, without further ado, I'd like to get on to the part of the show that you've been waiting for, which is our interview with Chris Sevigny. So here we go. Alrighty, guys, it's my honor to introduce my guest for today's show, distressed note expert and president of Sevigny Investments, Chris Sevigny. Chris, how you doing today?
Good. How are you doing?
Good. Thanks for joining us here. Very much looking forward to having you on the show and talking about your business, understanding the intricacies of what it is you do day in and day out. And so with that being said, Chris, give our listeners a sense of geography. Where are you based at today?
Yeah, so I'm in Northern Virginia, about 15 minutes outside of Washington, D.C. Metro area.
Okay, good deal. Does most of your investment activity happen in and around that area, or are you nationwide?
More nationwide with what we do in the distressed debt. To be honest, this area of the country is pretty wealthy, so there's not a lot of distressed debt in this area compared to other aspects of the country. So it's much easier to find a product elsewhere.
Okay, sounds good. And in the beginning here, what I love to do is kind of set the foundation. And, for those folks that might not be familiar with you, don't know your story, your background, what it is exactly that you do or how you got into it, maybe take a few minutes and just tell us a little bit more about yourself.
Yeah, sure. So I've been in real estate for over 20 years. In full-time job, I went from general contractor to developer about 8 years ago. And when I switched over to development side, a lot more people are entrepreneurial, and a lot of people I was working with had investment property, and they had cash flow on the side from their 9-to-5 job. And I got hungry and got the itch for that. So initially, my wife and I started buying some rentals, and we were buying rentals that need to be rehabbed in the Washington, D.C. area. And there were two choke points with that. One being price, because it's extremely expensive in this market. And the second being time. We got 2 kids, and we were trying to manage these flips and the rentals. And after the second one, my wife's like, okay, that's enough. We got too much going on. So I was looking at alternative investments, and that's where I came across note investing, which most people don't even realize exists. Some people here have hard money lending, but note investing is kind of a spin-off of that, where you're actually buying the mortgage note from hedge funds and banks on single-family properties. So that's kind of the roundabout way how I got into the business.
Okay. Sounds good. And just to give some clarity here, it's residential notes, not necessarily commercial. I know that prior to us starting the recording here, you'd mentioned that you do have one commercial note. It's kind of a fluke. It just came as part of a package or as part of a pool. But generally speaking, your business is built around residential distress notes, correct?
Correct. Yep. So single family homes, typically in the Midwest, where property values are between kind of 50,000 to 200,000 is our niche.
Okay. So being that we just literally went through one of the longest bull runs that this country has ever seen, real estate prices, higher than that of the peak prior to 2008 crisis. Most of the areas of the country had fully recovered. It seems that, unemployment was at an all-time low, and isn't at this point in time. Are there that many opportunities, or were there that many opportunities, again, prior to this COVID thing? But I mean, is it still easy to find opportunities given, how strong our economy was?
It was, and part of the reason why is it depends on your size of the company. We invest typically on average probably between $2 to $4 million per year, and when you're looking at in our acquisitions, typically range between $250,000 to $750,000 on a transaction basis. For that, we're kind of a small mom and pop in that sense. So yeah, you can find product. If I was trying to put, 5-10 million out the door, it gets a little more difficult in that sense. So from that range, but it has been a bull run, and where we've seen the product. What we've also seen though is price increasing from a decade ago on the distressed debt, which has gone up significantly.
Okay, so given that, what is the typical discount that you might find off the face value of that debt, or I guess what you could say is off the actual intrinsic value of that asset itself? I mean, what type of loan to value? I don't know if it's loan to value or whatever metric you might use to determine the value.
Yeah, typically you base it off of the lower of the property value or their unpaid balance. So either how much they owe or the value, because at the end of the day, in a foreclosure, you can only get what it's worth or what they're owed, the lower of those amounts. So typically, I, see stuff, on average between 35 and 55 cents on the dollar. For not distressed stuff, I see sellers trying to get 70, 80 cents on the dollar. And, typically I shy away from that because you can make some money, but the risk is just so significant when you're paying that much for the asset. It's a much higher risk perspective when you're looking at something, when you're paying 70 to 80 cents on the dollar. Okay.
So you said 30 to 35 to 55 cents on the dollar is where you like to be?
Yep.
Okay. And are these typically already in foreclosure, or is this a decision that the lender normally makes prior to going the foreclosure route, that they're just going to, they're going to sell off this thing, they don't want to deal with going through the foreclosure process, and they're going to let you handle it?
Yeah, most of them are not in foreclosure. Yeah. And what typically happens a lot of times is in the price point that I'm in, a lot of these funds may be looking at managing their $500,000 assets, and you have to spend the same amount of time on a $500,000 as you do on a $50,000 asset. Mm-hmm. So a lot of times it kind of just gets brushed aside, and they don't do a lot of contact or reach out on them. So the loans kind of just sit for a long time, and borrowers sometimes can get frustrated too because they haven't had contact. But I'd say 90% are not in a foreclosure situation when I acquire it.
Okay. And are most of these being purchased in a pool, or is it also one-off acquisitions?
I'll still purchase one-offs here and there, but as I've grown mostly everything now, I'll purchase in small pools, anywhere from some maybe 5, some maybe up to 100 assets in a pool. So.
Okay. Talk to me about that, what the due diligence process looks like, right? I mean, obviously there's the security is still the hard asset itself. You surely don't want to be, if there was original note, the face value was 100,000, you're getting it for 55,000, which is, supposedly 55 cents on the dollar. But for all you know, it could have been over leveraged and it's really a shack that's not really worth much more than $55,000, right? So that's part of the due diligence, I'm sure, right? Is actually understanding what the actual security is in the hard asset itself. But walk me through what some of the other aspects of the due diligence look like, just to ensure that you're not buying a pool of garbage.
Yeah, so the two main things you kind of hit upon it is the property itself. So one of the things I'll mention is I only deal with first position liens. There's other people who deal with second position liens, and there is difference in the two. And so I'm specifically talking about first position. And, first and foremost, you're right, the property value. What is that worth? And you got to be careful because a lot of people will send a realtor out. They'll send somebody by, snap a few photos, and then compare it to a recent sale that has brand new kitchen floors, and so forth. So you need to make sure it's being compared to kind of other REOs in the area or other distressed properties, because typically if the person's not paying their mortgage, a lot of times they're having trouble upkeeping their property. Mm-hmm. So that's one half of the equation. The other half is title, and making sure there's clear title to the property. Making sure that the taxes are paid, making sure there's no nuisance liens on the property, making sure that there's not IRS liens on the property, because taxes are usually the biggest, because you may look at something and it could, in some of these states like New Jersey, Pennsylvania, where taxes are significant, you could have a $15,000 tax bill that you got to make sure that you account for, because if you foreclose at the end of the day, they get paid too. So. Yeah.
Okay. So how does one go about doing due diligence? I mean, you're looking at a pool of, let's say, I'm just going to throw a number out there, 25 mm-hmm. notes. I know that you've got a smaller operation there. You mentioned before we start recording, you don't have any employees. So talk to me about how one individual can efficiently run through due diligence quickly, and get an answer back on whether or not you even have an interest in a pool of 25 notes per se.
Yeah, so typically your due diligence is done after you've gotten the bid accepted. So, you don't spend money until after your bid's accepted. Mm-hmm. So we'll put the bid, get accepted, and say I got 25 accepted. The first two things I do. Not
to interrupt you, Chris, but I want to back up. So what does given that's the case then, so that you're going to submit an actual offer and you're not going to actually spend any real dollars on the DD side until your bid's been accepted. But there's still some quick and dirty back of the napkin that goes into it arrive at it. So talk to me about the back of the napkin, quick and dirty evaluation, and then we'll dive into, assuming that the bid has been accepted, what the deeper dive into due diligence looks like.
Yeah. So the initial due diligence phase is, the seller will provide you what they'll call a tape, which is a list of assets, which will give you the property, property information, borrower information, when the last time they paid is, how much they owe, kind of that information. I will then take that information and analyze it, and basically plug it into a lot of that into my calculator. So I've created a pretty sophisticated calculator that will evaluate many different scenarios. If the borrower starts paying again, if I have to foreclose, if I, accept a short payoff, there's many different aspects from there that will kind of evaluate. And I try and target a 30% yield on my assets. So basically, we'll put in offers, typically based off of that, maybe, a little higher because we can negotiate. Mm-hmm. So we'll put kind of that in. What I'll do is I will look at the property. I use Data Tree, which is through First American Title. And really what that is, it's software that allows you to quickly get property information, and then it has links to like Zillow, Realtor, and Trulia and Google Street View, just to kind of do a street view to see, is the house still there? Because sometimes Google Street View, the house isn't even there, and it's like, okay, toss that one aside. But you want to kind of just get some type of information. The other thing I'll also do is I'll go on the county website and check the taxes as well to see, hey, how long's the taxes been outstanding? And then from there, basically, you'll formulate your bid. So that's kind of the down and dirty. I probably spend, I would say, between 15 minutes and 30 minutes per asset on that initial bidding due diligence, to give you an idea.
And how close can you actually get? I mean, realistically, what you can get within, let's say, 5 or 10% of a real value from doing that quick and dirty?
Typically you can, but there's also somewhere, if it's a little more rural, the Google Street View might be 7 years old, and then all of a sudden you send somebody by and the house, I had one in Maine where the house had the roof collapse, on it. So then, once you send somebody by and they take the photos, then you just go back to the seller and say, hey, I'm passing on this one. By the way, you should know that the roof is collapsed on this one as well, or something along those lines. But
typically, if you're being provided a tape of 25 properties and you've got one like that that you just really don't have an interest in, isn't it? I was under the impression that you pretty much have to take it all or nothing. Is that not the case?
Typically not the case.
Okay.
And, because you can negotiate that out or just negotiate it at a reduced price, from that perspective. If there's some type of like title fault, I've had issues where there have been major title flaws that are nothing you can do. I'm not going to pay for that. They want to throw it in so they can close out their fund. I've done that in the past where, they throw it in and put a number of $100 to it as part of it. So that hedge fund can close out, it's a closed fund, so they can close it out. But, if I had bid 10,000 on it and it had a fatal flaw, that gets negotiated out or, thrown in for nothing. So things that are like that, you can toss aside.
Got it. What might be an example of a fatal title flaw?
So one, for example, is, here's one actually I dealt with literally today. It's the seller claimed it was a first mortgage, and it was a line of credit that was recorded out of order, but in the first position. And the house is only worth probably about $50,000, and it's $100,000 value is the first position note. And this one, basically, it got recorded out of order, and the lien holders actually filed suit to get put back in the first position to basically wipe out that second lien. So that's one. I've seen also another situation, especially with contract for deeds, where, that's a whole nother animal, that the title's not transferred until the person pays it off, where the seller's gone bankrupt and they never issued proper assignments as well. Bankruptcy Chapter 7s that then go to tax sale. I've seen where somebody filed bankruptcy Chapter 7, they get rid of the property, and then the lender didn't do anything with the property and then let it go to tax sale. That's something that, you can't recover anything because it was a bankruptcy. So those are just several. I mean, as you get into the business, it's pretty unique, some of the things that you see occur.
Is it your objective to to purchase notes on properties that have owner occupants currently living in them or still living in them, or would you prefer to have them vacant?
No, occupied. Pretty much one of my criteria is, probably 95% of the stuff I buy is occupied. And the reason why is I want to try and work something out with these borrowers. But paying it a discount, it's much easier to try and work something out with them, because at the end of the day, it's two things. One is my philosophy is, I try and help others, and, so we try and work with them to keep them in the property. But on the second component to it is, it's more profitable keeping somebody in the property than having the foreclose. At the end of the day, because people say, well, how's that the case? Well, if you get them re-performing and paying again, and then you can turn around and sell that as a performing note a year and a half later at 80 cents on the dollar, think of the margins that can exist with that.
Got it. And what typically, what's the game plan if it's either vacant or if you've got a borrower? I mean, some borrowers just end up throwing in a towel. Even if you want to work with them, they don't care, right? They're ready to move on with their life and just get past this piece of their life and start a new chapter. So what is the game plan in a situation like that?
Yeah, first is we try and reach out to them to see if they'll just deed the property over to us. That way we can avoid foreclosure. We can avoid the expense of foreclosure and basically wipe out the debt, give them basically a release that we're not going to come after you for any amounts owed if you, basically sign the property over to us. So that's what we typically try and do in instances where, there's not a second mortgage on the property or there's not other, potential issues that may arise. I had an example once where I was going to sign somebody, have them sign a deed in lieu, and they took like 2 months to do it. I reran a title report only to find out they were using it as a rental and they weren't paying the property manager. The property manager slapped a $10,000 lien on the property. So I couldn't take the deed in lieu because I would have now been responsible for that $10,000 lien. Unfortunately, we had to foreclose because that property manager, I offered him $1,000 and they said, no, we'll only take the 10. I'm like, well, you're going to get nothing. You realize that. And they thought I was bluffing. So.
Okay. Well, very, very interesting. And so what is the long-term game plan? You get these things reperforming and there's obviously a secondary market. You had mentioned, get it performing, have it seasoned for a year and a half, and then potentially exit out of it, sell that performing note. What does that secondary market look like? And is that typically your exit strategy?
Yep. So, that is our exit strategy. And typically we'll, the last year plus I've been raising money through funds. So I did Regulation D 506C fund with accredited investors, and we typically put like a 3-year sunset period on those. We raise money by performing, non-performing, and sell to that secondary market, which is typically other smaller investors that will be looking out there. A lot of people with self-directed IRAs is something where people who have retirement money not into through mutual funds or anything that's in their control, they'll buy it, and typically we'll sell these assets to them, getting them 10 to 12% yields on returns is what we'll sell them for. And, people, are happy because a lot of time, it's secured by something. So they're getting, it's not like the stock market where, you do have companies who have, a lot of cash, but it's easier to understand that, okay, I'm buying a $40,000 loan on a $100,000 house. People can visualize that, see it. And also, a lot of people find real estate sexy in that sense where I want to be a real estate investor. So that's where we see a lot of that secondary market.
Got it. When you're raising capital for your fund, what kind of info do you typically provide your investors? I mean, are you basically supplying them with, the tape of what you're about to buy, as well as maybe a picture of each one, just so they have an idea of what asset these notes are actually attached to that you're looking to invest in?
So, typically, we'll do the raise and then, buy after, we raise or get the commitments. But I believe I'm more transparent than most other funds in the sense of I have a portal where they can log in and see the data on every single asset in there, good, bad, and different, because it's the same portal that I use to manage the fund. They have access to see, the loans, when the last person paid is. They get the address where they can look up the property, info as well. If they want to look at the collateral, I'm of the belief of the more educated your investors are, the better things can go. I'd much rather work with somebody who is more, a pain in my rear because they know a lot than somebody who doesn't know anything. Because the minute, if there is any type of, if anything were to, hit a bump in the road, those are the types of people who then start, I believe, tend to panic a little more just because they don't know.
Sure. No, that's a great point you make there. How about the servicing of these notes? I mean, do you service them yourself? Do you outsource that to a third-party servicer?
Yeah, I outsource that to third party. There's 2, 3 servicers that I use within the business and let them, and again, it's more, especially for protection, because servicing, it's very complex, especially on distressed debt, on calculating payoffs and, deferred interest and, late fees and so forth. So we use licensed companies to do all of that. And that's one of the things that has allowed me to grow without bringing on people is the fact that, I use servicers, I use preservation companies, I use attorneys, I use companies to record all the documents for me. I use a bookkeeper. So a lot of things that people may be doing in-house, I'll outsource that to people. That's all they do for a living, which allows me to focus more on the business component than, trying to get copies made of something along those lines, the nuisance work.
What are some of the biggest mistakes that new investors, maybe even yourself, made, and right from the get-go when you started, getting into this business and buying notes? I mean, what are some of the big no-nos that maybe hopefully those that are listening can avoid should they start to explore this space?
Yeah. So a few no-nos that I mentioned is, from the educational component, a lot of people get educated from, people out there. And, I recommend people always get educated in something. But then a lot of them will turn around and buy assets from the people who educated them. And to me, it's a conflict of interest because a lot of the stuff that gets sold is overpriced and questionable from that perspective. Another one is, again, people overpaying. And where I see the biggest mistakes where people overpay is, people hear numbers tossed out like, oh, you pay 80% or 60% or 40% for assets. And like performing, a lot of people will throw out 70 to 80 cents on the dollar. But what you have, people do not calculate the math side of focused on what is your return. Because what happens sometimes is, especially these HAMP loans that get modified down to 2%, you could have a $100,000 loan that their payment is like $300 a month. And somebody turns around and will say, oh, I'm going to pay $80,000 or $70,000 for that loan that's only paying $300 a month. Do the math that it's going to take you, basically, 20 years to get your money back, and name of the game is to try and get your money back in 4 to 6. So that's where I see a lot of people making mistakes. And the other two is people not using the experts. I mean, not hiring an attorney also to review the collateral, because states are very specific in regards to different laws. I ran into an issue where we had a power of attorney sign a document, but the power of attorney didn't notarize the power. Somebody didn't notarize a power of attorney form and record it, so it created a quiet title issue that cost me $3,500. It wasn't detrimental, it wasn't fatal, but it still was something that I didn't know, and even actually my attorney missed it, but it was still a mistake that still cost me over $3,000 that wish would have got picked up. So.
Got it. A couple other questions I have for you. We've been talking about kind of distressed notes or non-performing notes, but you dropped the word performing notes a few different times.
Yeah.
Give me an idea of what's some of the reasons behind why a fund or a lender would basically sell at a discount a performing note.
One is because they picked it up at a distress rate, and now they're looking to capitalize and basically refill their coffers. So if they may have bought it for 35 cents on the dollar, they've had it for 2 years, person's been paying, and they can turn around and sell that thing for 80 cents on the dollar, they're basically making significant money on that. Take a $50,000 loan, say they paid $20,000 for it, then all of a sudden after 2 years of collecting payments, they're selling it for 40. They're making double their money. And bird in hand is better than two in the bush sometimes, where hey, I've had this performing for 2 years, the economy may be slowing down, I don't know if this borrower, they may not have a job in a year, it could go non-performing again. Let's sell it, while we can, from that perspective. So that's one. The other is just funds. Funds, some of them have sunset periods where they got to sell, they got to close it and sell the assets. So that's another.
Got it. Understood. And when you're purchasing these notes, whether performing or non-performing, are you getting an entire credit profile of the borrower?
Typically, you'll get the credit profile from the loan application. Now, an updated one, some provide, some don't. Typically, I'll run, a TLO on them, basically to check, judgments and other things. But I usually don't run a full credit report on them, more because in first position, you're more concerned about the asset value than the borrower's performance in some sense, because the credit reports can sometimes show good or bad, but at the end of the day, you're buying at a distressed number and you want to try and get them in. But I've had borrowers who, when I run credit, they've had nothing on their credit and they don't pay. And then I have people who have student loans up the wazoo who find a way to make a payment. So It's really not in second position, it's much more important than someone in the first position.
Okay. What percentage of the time do you actually have to push forward with a foreclosure, assuming that they're not interested in staying and readjusting the loan or doing a workout? They have no interest in working with you, doing a deed in lieu, right? They're just being a difficult borrower and they're going to make your life a living hell. What percentage of the deals you do on an annual basis are those?
Very small, probably 5 to 10%.
Okay.
And people would think it's higher, but one of the things also that I try and focus on as part of kind of that, review of credit is, one of the things I like to buy loans where the borrowers are a little older. Borrowers who are in their 50s plus, age. And the reason why is people in that age bracket, I'll be 45 this month. I don't want to move. I can only imagine being 50 something years old, lived in a house for 15 years. They don't want to move. They're going to want to do whatever they can to work that out. So a lot of times, when they can't, their default might be a bankruptcy, which is not a bad thing. I actually, enjoy it. I like buying bankruptcy notes because you get to see everything. And then there's a plan that basically is run by the bankruptcy courts to make sure that they stay on queue. But it's actually not super high because of the fact that I'm buying a lot of occupied properties and they're owner occupied, not rentals.
Got it. In the event that you actually have to go through that foreclosure process, how do you typically, so obviously get an attorney involved to go through the legalities of the foreclosure, but once that property comes back into your possession, what's the game plan thereafter?
Yeah, first and foremost is to get a preservation company out there to, assuming, once it's vacant, change the locks, winterize the property, do an inspection on it, kind of get a feel for what needs to be done, and then get it cleaned out, because it's usually, I have had on one occasion where I foreclosed and they actually left it spotless, which I kind of chuckle at, because usually these places look like, some stuff you'll see on TV, on the internet, some of these landlord tenant, from hell shows. So that's really the first thing. And then one of the key things to do is find an agent when you go to sell this thing who is familiar with distressed properties, because more than 95% of these properties are distressed. And you don't want, a Sotheby's, agent who sells $2.5 million properties, because the first thing they'll do is come in and be like, well, you need to stage it and have a cleaner and everything else. And it's like, no, I'm not spending any more money unless it's going to give me money. Typically it's going to be an investor who doesn't care, or you may try and owner finance it. And that's another avenue that we find helpful, is owner financing it to investors or other people who want to, live in the property.
Got it. Okay. So given the time that we're in, number of months into this pandemic, lots of loans that are in forbearance, the programs keep changing and changing, unemployment, I don't know if it's going to get extended, the additional benefits in July 25th. We've been I feel like there's been some glue, some government glue that's really been holding all the pieces together here for the past number, since March. And at some point in time, I think the glue will come undone. Maybe not all of it, but we obviously can't keep gluing things together, and temporarily bandaging stuff. And, there will be fallout. I don't know how significant it will be, but what do you anticipate? And what kind of is your industry anticipating as far as overall distress that's going to be a result of, this pandemic, at least in the residential sense, and folks potentially, defaulting on their homes?
Yeah, and it's interesting you mentioned about that glue, and a lot of people I've spoken with, and we have a lot of talk about this, is that glue will be in place till November because of the election. So we anticipate everything the government can do until that time, for political purposes, will probably be done. And then, what's interesting is on the state level. So there's two aspects to this. Is one, which is the lenders and what Fannie and Freddie are doing, which, the loans that lot loans we also buy weren't, Fannie or Freddie loans. So we're, able to do what we want. It's about a 50-50 split right now in the market of the $30 trillion mortgage industry. I think it's about split in half. So we're allowed to kind of do what we want. And I think the sense has been, the more focus is on the jobs, be honest. When people have jobs, they want to stay in their house and they can pay their bills. If the housing price crashed by 50%, a lot of, it may not be effective. People are still working because people aren't going to liquidate their properties. If they're in there and they're paying you, it's kind of like having a rental where, property values may go up and down, but you got a tenant in there, you really don't care. So that's one aspect. The other aspect has been the states themselves and what they're doing within the court systems and the laws that they've been implementing in regards to pushing things out and the moratoriums that they've had. What's, I think, unfortunate is, basically they've done a lot of the protection for the tenants and borrowers, but, a lot of the smaller landlords are the ones I think are feeling a lot of that brunt right now, and especially us as lenders. I mean, I have some assets that, people haven't paid in 3 years. I purchased a note last year, and we've been trying to, go through the process, and this borrower has no interest in paying the property, but they just want to keep living there, and they know they can. And those are the ones that, make it more challenging because, the states have put a one size fits all in regards to people who haven't paid, whether it's pre-COVID or post-COVID. And what's going to happen is, there's probably going to be a knee-jerk reaction because there is going to be a flux of foreclosures and evictions that come down the pipeline. So I think it's going to be delayed, and it's going to be similar, I think, to the foreclosure crisis in the sense, not as large, but how there are a lot of zombie foreclosures. And I think you're going to see a lot of zombie foreclosures come back again where, things, happen from that perspective.
What do you mean by zombie foreclosure?
So zombie foreclosure is basically the lender basically is holding off on foreclosing because of too much going on in the courts, or the states cracking down on basically trying to push them out as long as possible, or also properties that have become vacant in some sense. I know some tenants and so forth who are, doing everything possible to, people who aren't paying to find a way to get them evicted. And from a lender's perspective, for example, I've got a property right now that basically, like I said, it was one of those throw-ins that, taxes are owed and the borrower just hasn't paid. So I've just decided I'm just going to let go tax sale, ride it out on tax sale. And if there's an overage, meaning somebody pays more than what the tax are owed, I'll get my money from that because, I'm kind of tied. My hands are tied with the courts right now.
Interesting. How about, vacation rentals, especially those that build a business on Airbnbs, and if they're down here in Florida where we're based, I mean, I think that business has come back full swing. However, there's lots of the country, Airbnb rentals that are not being occupied. I mean, at all. And, again, businesses have been built, small little businesses where people have purchased 1, 2, or 3 units, and they are relying on that Airbnb income. And I think there's going to be a major amount of defaults in that space as well. What are your thoughts? And is that would those be of interest to you, being that they're not owner occupant?
So, it's interesting because, yes, I believe there's going to be a influx of foreclosures on the Airbnb and on that market. And interestingly enough, I've been looking at that more for not from note investing, but from diversification. Honestly, I still have some rentals, and I have notes as my primary investment avenue, but I like to diversify. And my wife and I have been looking at picking up a rental, a short-term rental, and we actually had one under agreement in February, right before COVID, and then basically the seller bailed. It was a LLC that had 3 partners, and then the third partner decided he didn't want to sell it at the time, and so forth. And then they put it back on the market. And interestingly enough, it sold for about 30 grand less than what we had offered on it, which we're glad now during the COVID crisis. But yeah, I think you're going to see in some of these markets, definitely a hit on the non-owner occupied, whether it's Airbnb or just rentals. Some of these markets that have really been up and coming recently, like, Indiana, the, Memphis and Nashville area. I think you're going to see a lot of those get hit because of the fact that it had such an influx of the turnkey rental market, whether it's Airbnb or just regular. I think investors are going to realize that, hey, I haven't got, a lot of people buying these are newer investors who don't have financial support behind them to carry costs for a significant amount of time.
Yeah. No, it's scary, and time will tell. But and I agree. I don't think we're going to see the worst of it until after the election, right? And whoever becomes our either current or new president, depending on how the election swings, is going to be handed a bag of crap, basically.
Oh, it's going to be it's going to be a mess. And people ask, in our business, when do we expect to see the influx of assets hit? And I know some people have, saying, oh, it's going to happen, the end of this year. And personally, I don't think it's going to be till probably another 12 to 18 months.
I agree.
It's going to take a while for everything to get sorted out. And from that perspective, and then again, when it flows downhill, you've got first the banks, then hedge funds, and then, larger firms. And then, when people who, are size that I'm at, I'm pretty much not the bottom, but, on the lower tier, it just takes that progression does take a while before we start to see some of that product. Yeah,
I agree with you. One last thing here before we move on to closing. Talk to me about the relationships with these different lenders, as far as, getting access to these potential distressed notes or even performing notes. I mean, what does that look like for those that are listening that might have an interest in stepping into the space? Where would one even begin?
Yeah. So, a lot of people talk about the banks, but most of the relationships are with hedge funds because the banks themselves, they don't really sell a lot of their product. And if they do, they'll usually bundle it and sell it to larger hedge funds who they've already built those relationships with. It's like the way I look at it, it's like you can't go knock on Ford's door and say, hey, I want to buy some cars from you. You got to go to a dealership, similar to some of these lenders. They have preferred people who they'll push, some of this debt off to. And really it is a huge get to know business, and you got to prove yourself. And the biggest way you need to prove yourself is, working with somebody and doing what you say you're going to do. Close the deals. What happens sometimes in this business is people get deals under agreement, but they don't have the funding behind them, and they have to walk from the deal. That really upsets individuals, that are selling. So it's just do what you say you're going to do. People typically start out, there's some sites out there that sell one-offs. One called paperstack.com is a site that a lot of people will use. There's a few, I'll call them brokers in the business who, represent some funds that are pretty well known, who it's nice to build a relationship with. Servicers are another source for, a lot of times they will put notes out for sale because they have investors that are looking to sell, and they have relationships as well. And then it's just trying to meet some of these funds at events. IMN is an event where you can meet some investors and funds at, and buy them dinner. And the big thing is, build the relationship. Don't walk in saying, hey, I want to buy stuff from you. It's, more the conversation of, what do you do? Is there an area of your business where, we could work together, that I might be able to solve one of your choke points or solve more problems? Like, I've got a fund right now that they don't like to foreclose. And, their business model is not to foreclose. So when they have any asset over a certain period of time, or if it has some title issues, I work with a nationwide title company who can clean up a lot of this stuff. So they call me up and say, hey, I've got these 5 title issues. Do you want them? I'll take a look at them, talk to my title company, and then a lot of times I'll, buy them from them, and I'm solving a problem for them.
Mm-hmm.
And that's something that I think is critical in this business as well.
Okay. Fantastic. That's great advice. And I'm guessing, given the current state of affairs in this country, like events like IMN, they're not happening this year. So what are some of the roundabout ways? I mean, LinkedIn probably, really, is there a place one could find maybe a starter list of the different funds that really play in the note space?
Yeah, I actually, on my YouTube page, 70 Investments, the number 7, the letter E, Investments, I actually did a webinar that shows 20 places where newer investors can start networking.
Got it.
The other major place you find is Bigger Pockets. Bigger Pockets is a website that has a lot of information on there. So that's one. Facebook groups, you'll see, there's some note investing Facebook groups out there as well that people have. And then, but a lot of those events now actually the benefit is, instead of spending $1,800 going to these events,
they're virtual.
They're virtual, and they might be free or $100. So that's another, area that, has been a benefit as well, is being able to do these on the virtual side.
I still miss the in-person networking. I do. I
do too.
I'm very much a homebody, and I enjoy spending time with my wife and kids and not being forced to go travel. In fact, last week was the first time I traveled in the last four months. But I also do enjoy, going and networking and getting to meet new people and seeing old friends and colleagues and things like that. So hopefully that time will come back in the near future.
Yeah. But I will say it can be done because, between I work full time, I have kids, my weekends are soccer, taekwondo, swimming, whatever it may be. I don't travel a lot to these events. And, it's also, one of these things called the phone, that it's amazing how you can just find somebody and speak to them. And now with Zoom, a lot of people using Zoom. So while it's beneficial to go physically meet people, it's not impossible. The 2 biggest people I buy from, actually, I have never met.
Oh, that's good. That's good. Yeah.
So and one of them is actually in Maryland, probably like an hour and a half from me. And, we talk on the phone probably, 3 times a month for trying to work deal flow and stuff. But, honestly, never met the guy. So it can be done.
Fantastic. Well, you've shared a lot of great information with us today, Chris, lots of golden nuggets. And what I'd like to ask you, if you had just one last final golden nugget of advice or wisdom that you could leave with our listeners today that might inspire and motivate them as they progress in their own real estate investing career, what would that one last golden nugget be?
So, great question. So overall in real estate, it's, make sure you also take a look at risk. One of the things that I see with a lot of investors, no matter what your investing is, they're only looking at the numbers and they forget to measure the risk that's involved with that investment. And that's really the thing that I try. And when I talk to investors and when I preach to people on my podcast or within the note space, about looking at these assets, especially people on the rental side too, where it's like, oh, I can buy this property for $100,000 and it's gonna, it gets $1,800 a month in rent. It's in an area that's depressed, it's not appreciating, and it has potentially other issues, might be on a septic system, for example, or whatever may happen, has a lot of costs involved. That's the one thing that, again, you can't just look at the numbers. You have to understand the risk involved. And unfortunately, that typically comes with experience. And that's where you really should try and find a mentor or somebody that you basically, a buddy that you have these conversations with to bounce ideas off of, just to be that little, devil or demon or angel on your shoulder, just giving you some of the insight that you may be short-sighted on.
No, that's great advice. And yeah, phenomenal, Chris. Well, buddy, this has been a lot of fun. That's all I have. I mean, is there anything else that you could think of that we might have missed that you feel would be relevant for those that are interested in this space? Anything whatsoever?
No, it's, I just like to talk about the space because a lot of people, again, out there never even heard of note investing and don't even know it exists. And it is a very small niche industry. And the last caveat or last thing I'll add to that is it's like any real estate business. It's not a get rich quick scheme. It takes years to build your business and to grow it and expand. But once you get that train moving, it can be provide significant and good cash flow for today and in the future. So it's another option for cash flow.
All righty. Well, fantastic. Well, thanks for joining us here, Chris. And guys, if you want to learn more about Chris and his group and what they have going on, you go visit their website. It's 7einvestments.com. That's the number 7 and then the letter E investments.com. And I'll be sure to put that in the show notes as well. And again, thank you, Chris, for joining us. And guys, thank you for tuning into this week's show. Until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.